Hello, everybody. Welcome to our November webinar, Outlook for 2024, Normalizing the Economy, with a question mark at the end, which is pretty important. Thank you, everybody, for joining us. My name is Gerry Celaya. I'm the Chief Strategist at Tricio, and today giving the majority of the presentation is my colleague, John Calverley, Tricio's Chief Economist. I've worked with John since 1996, and he's one of the best economists I've ever worked with. He's very practical, and more importantly, he's very optimistic for an economist, even though it is a dismal science. So, John, without further ado, I'll let you kick off.
Okay, well, thanks, Jerry, and welcome everybody. What I wanted to talk about today is what I call the normalizing economy. And in looking at that, I'm going to be looking at inflation trends and recession risks. I'm going to be trying to look at what are normal interest rates now, productivity and AI. And then we're going to give you three risks, and Jerry's going to chime in with three opportunities. So without more ado, let's get started. So first of all, what is it that's normalizing? Well, obviously, COVID and really the post-COVID effects are fading. China perhaps is the last to be feeling this, but even there, I think the effects of COVID are fading now. We've got interest rates off zero after more than a decade of zero. We don't know, of course, what is the new normal interest rate. Is it 5? Is it 4? Is it 3? But I'll talk about that. But definitely zero never felt like normal. We've got labour markets back to what I would call normal strong after a period where they were very strong. If you looked at the US, you had vacancies extremely high. You had people quitting at a very high rate. That was a very unusually, abnormally strong labour market. It's still strong though. Unemployment is still low everywhere, up slightly, but still low. We've had inflation approaching 10% in many countries, and that's coming down. It's still too high, but it seems to be getting a bit more normal. We also have house prices falling from extreme highs in many countries. The US is a bit of an exception where prices are rising at the moment, but elsewhere they're falling some. And if you factor in inflation as well, then real house prices are falling quite a lot. And finally, we had this period of huge budget deficits during COVID, and they're generally falling, although again, the US is a bit of an exception here, where the deficit's actually risen this year. So let's dive into inflation, which has been really the big issue this year, and I think will still be the big issue next year, or at least one of the big issues. This is core inflation. It got to about 5.5 in the Eurozone, 6.5 in the US, just over 7 in the UK, and is coming down. You look at the red line, the US is ahead of the others, probably about 6 to 9 months ahead of the Eurozone and the UK. It also went up before the others, so it's basically on an earlier trend. 4% inflation, as we have in the US and the Eurozone, is still way too high. There's still a lot to go. The central banks are concerned that inflation will be persistent, or there could be second round effects. So central banks still want to keep things tight for some time yet, and they really do want to get to 2%. So don't listen to anybody who says, well, maybe 3% is okay. That's not how the central banks look at it. The key to this is going to be wages, and this is the Atlanta Fed wage tracker, which the Fed in Washington looks at very closely. You can see it's already come down quite a bit, but it's come down about half the distance it needs to come down. And the signs are from this and from other indicators that wage growth is slowing nicely in the US. It doesn't seem to be doing quite so well in terms of coming down in the UK and the Eurozone. And I think there are some concerns that there it's going to take somewhat longer. We don't really know how much the labour market needs to ease off to bring wage growth down, but that's going to be critical as we go through the next year or so. Here's one sign, though, that inflation will come down. This is the money supply growth. The red line here is the US. You see that huge blowout in money supply in 2021, over 25%. Now it's negative, and it's negative in the UK and the Eurozone as well. Now, falling money growth does tend to bring inflation down. Of course, it also brings slower growth, and it also can bring weaker stock markets. So exactly how it's going to play out in terms of those three things, inflation, growth, and markets, is going to be critical. But I do take some comfort from this in the sense that I think it means that inflation is going to come down. It does, however, raise question marks over growth and to what extent we might see something worse than just a slowdown. So let me move on to that question. The US leading index has been falling for about 18 months now. This chart shows the 6 month change. You can see how it's been negative for some time. It's actually slightly less negative than it was 3 or 4 months ago. And I take some comfort from that. The conference board itself, this one comes from the conference board, still believes there will be a US recession. I think probably it's about 50-50 now among economists, maybe slightly less than 50-50 for a recession next year. Our view is that there probably won't be. Number of reasons for that. One is that US profits are still fairly high. This chart shows profits as a percent of GDP. And you can see they came up in the 2000s and they got to a peak just after COVID. That was a period when basically firms weren't discounting at all. There was such strong demand. Profits have come down a bit. You can probably see just at the end, it looks like it's picking up. And indeed, profits are picking up at the moment after being soft over the winter. But this is a pretty high level. And usually, if profits are strong, companies don't lay people off. They don't cut back investment. It's unlikely you'll see a recession when profits are this strong. Typically, what happens is they fall significantly before the recession. And that's partly what triggers the recession. I've got other reasons, though, too, for why the slowdown shouldn't be too serious, shouldn't be a recession. The first one is that house building and the industrial sector have already been through something of a correction. It's kind of like a rolling recession, as some people have called it. So with house building, for example, that's usually a big player in US recessions. And housing starts have come off about 300,000 at an annual rate, and they're running at a fairly low level now. Potentially, they could come off further, and I was worrying about that particularly a few weeks ago when bond yields were particularly high and mortgage rates were particularly high. Well, that's come off a little bit. House building, I don't think it's going to be strong next year, but I'm not sure it's going to be a major downside risk for the economy. And with industry, we've seen worldwide an industrial recession this year. If you look at the manufacturing PMIs for the US and elsewhere, they've been very low. Chances are they'll turn around because industry tends to go in sort of a 3 to 4 year cycle. And chances are that industry will actually pick up. And we see that when we look at inventory levels, where generally speaking, inventories have come down for wholesale, for manufacturing. They don't seem to be at a worrying level. That should suggest that industry will pick up over the next year. Another reason is that balance sheets are generally strong. If you look at consumers, for example, house prices, as I mentioned, in the US are actually rising. Stock prices are pretty much holding up. So households have suffered some, yes, from the rise in bond yields, which would have lost people some money there. But there's nothing like the situation in 2008, 2009, when households faced this collapse in house prices. And it's the same with businesses. Generally speaking, I already mentioned profitability. Of course, there's debt that has to be refinanced, but many companies actually refinance when interest rates were really low, and they don't face an immediate refinancing problem. So this is going to be an issue for some smaller companies, certainly for some in the commercial real estate sector. But generally speaking, balance sheets in business seem pretty strong. And then finally, for banks, yes, banks have the issue that they may be underwater on some of their long maturity debt. But for the rest, they don't look anything like they did in 2008. Another reason why I think the slowdown shouldn't be too serious is that I think inflation is going to continue to come down. And especially if any sign of a recession is delayed a bit, doesn't happen yet, but happens, let's say, second quarter next year, third quarter next year. I think inflation by then, particularly in the US, will be low enough for the central bank to react by cutting rates. I'm not sure they're going to have emergency meetings to do that. I think they will respond, I think, if it looks like the economy is weaker than they expect. There's one other thing here, one other factor here, which isn't on this chart, which is what's happening to real wage growth. So we're seeing headline inflation come down pretty fast, partly because energy prices are low. And that's really helping with consumers' real disposable income. And that too is going to help with spending. So our overall view on this is that there's a 40% chance of a US recession in the next 18 months. Now that's higher than normal. I wouldn't normally have it that high, but it's 40%, it's not 60%. And any recession, I think, should be mild. So this is a picture of GDP going back to the fourth quarter of 2019. You can see the COVID dip, the recovery. US doing much better than the other countries. And that's partly due to productivity, which I'll talk about in a moment, but it's also due to an increase in the labor force. Whereas the UK and the Eurozone, pretty flat really for the last year, 18 months, flirting with recession. And so while I think that the US will most likely avoid a recession, I think it's a close run thing for Europe and for the UK. The risk of a recession, there's already the odd negative quarter in various countries in Europe. I think the risk of an actual recession is much higher. Having said that, I don't think there's going to be a major recession, even in Europe or the Eurozone, sorry, the Eurozone or the UK, largely for that reason of real wages I mentioned, that they are improving dramatically as energy costs come down. So what can we say about interest rates? This is the federal funds rate going right back to the 1960s. So what's a normal rate? I think if we look in the 1990s, you see that quite long period in the sort of second two-thirds of the 1990s when we had a rate about 5.5. And that was regarded as normal then. Bear in mind that the US economy was strong and productivity growth was strong at that time. So maybe that helped to justify over 5% rates. Then we had 5.25% just before the great financial crisis, but of course that did lead to a major bust. So it seems 5.25 was too high back in 2007. And then in the 2010s, the Fed funds rate got to about 2.5%. The US economy slowed and the Fed started cutting rates, and that was before COVID. So now we're back at that 5.25% or so level. The Fed thinks that's restrictive. So do I think most economists, but exactly how restrictive is a big question. So one way we can get at this is to try to work out what is the real neutral rate. So this is the rate at which inflation is neither rising nor falling. And there's various calculations. These are two different models here. If you look at the where it comes out at about 1% currently on the left-hand chart and about 0.5% on the right-hand chart. So that's the sort of range that I think the central bankers are thinking of as the real neutral rate. So you've got to add that to inflation, of course, to get what the nominal neutral rate would be. So that would give you, if you think you're at 2% inflation, that would give you something like 2.6 to 3.2%. At the moment, the Fed is still publishing 2.5% as the neutral rate. But it was noticeable at the last press conference that Chair Powell didn't want to talk about that. And I suspect they rather think it's higher. And some other central bankers have talked about the neutral rate being a bit higher than it used to be for various reasons. So I think between 3 and 4% is probably more plausible for what the normal policy rate will be once inflation's down, once the central banks ease policy. Where we're headed, I think, is 3 to 4% for the US, about the same in the UK, a bit lower perhaps in the Eurozone. What does that mean for bond yields? Well, you've got to add a term premium for people taking the risk of buying longer term paper. So that would put the 10-year yield at somewhere in the range of 3.5 to 5. So we were at the top end of that range just a few weeks ago. I think it's about 4.4% now on the US 10-year yield. So we're still in the upper half of that range. Let me turn to productivity. And this chart shows output per hour for the US business sector and for the UK whole economy. There's not quite apples and apples here. Obviously, the whole economy includes the public sector. But I think it still shows the trend, and there's some interesting things from this chart. If you look at the left-hand side of the chart, you see that the blue line for the UK is rising at about the same pace as the US. So the UK had really a golden age of productivity in the 90s, and the early 2000s, where it was catching up with the US. Then you had the crisis in 2008, and then what I call the lost decade. You can see that it took really until 2017 before productivity actually started rising above where it was in 2007, 2008. And it's risen since then, the blip during COVID, and it's still rising. If you look at the US, overall, it's on a steeper slope. That means faster productivity growth. Notice also the US seems to do well during recessions, or just after. 2009, 10, there was a big leap up. And again, with the effects of COVID, there was a big leap up. What seems to happen is that recessions in the US shake out a lot of labor and capital. There's a lot of companies go down. And when they put it all back together again, you've got higher productivity. That doesn't seem to work so well in the UK or in Europe, for that matter. One good piece of news for the UK is that investment does seem to be picking up now. You can see the trend for the US, investment strong. That's great. That's very positive. If you look at the UK, investment was rising at the same level until the Brexit vote, then went flat. But it's picked up recently, and that's a positive sign for productivity. The Eurozone has been lagging for a long time. Obviously, the Eurozone crisis in the early 2010s held things back, and really on a pretty sluggish trend here. I wanted to say a few words about AI, artificial intelligence. This is a chart from Bain consultancy. You can see it shows the estimated percentage of labor time that can be automated using generative AI. Things like ChatGPT and the creation of images, film, etc. And these are quite startling numbers. So they're suggesting that 27% of labor time expended in the leisure and restaurant sector could be automated. And on the far side, professional services, which is, I guess, what most of us are involved in, 41%. So overall, this is about a third of labor time that could be automated using generative AI. Now, this is a consulting company. They always like to hype things. This is a huge effect. I mean, if you actually suddenly could automate a third of your labor time, you'd effectively raise your productivity by 50%. So that would be huge. I don't know whether it's right or not. I do think that generative AI is going to make a big difference. It's different from AI that we were looking at before ChatGPT, in the sense that before then there were various IT departments and companies trying to work out ways to use AI to help with their processes, etc. What this does is give anybody in a firm, for a very cheap price, a tool that enables them to improve the way they do their job. And it's being widely used, particularly in marketing and sales departments, but also developing products and services, and also in customer service, fulfillment, etc. So I think this is going to make quite a big difference. And if you can raise productivity growth by just 0.5% or 1%, that can make a huge difference to an economy. So I think this is a very positive thing. In terms of where productivity is going, and I've just said that AI could be transformative. There are other things going on, of course. Robotics, AI, of course, links in with robotics, but they are separate to some degree. There's the Internet of Things, biotechnology, additive manufacturing, lots of other things going on. So I think Gerry said at the beginning, I'm an optimist. I've long been an optimist on technology. I think there's a lot of exciting things going on, and I think these can add to productivity. Another pro, I think, is that higher interest rates should bring better allocation of capital. I think we had a problem in the 2010s when capital was basically too cheap and it was not being allocated effectively. I think when you get back to a more normal interest rate, you're going to get better allocation. Against this, though, I think there are some trends in the economy which are not new, going on for some time, but I think they do hurt productivity. One is regulation, where we see massive amounts of regulation over the last 20 to 30 years in every economy. And I think that's really hurting investment in many areas, slowing it down. And then there's the green transition, and Gerry and I have debated this, but in my view, it will hurt productivity. It's something we have to do. We have to reduce carbon emissions, So in the long run, we have no choice, and in that sense, it's good for productivity. But in terms of economic growth over the next 5 to 10 years, I think it's going to hurt, and it hurts because we're using more expensive energy, for example, than we otherwise would, because we're using more expensive cars, electric vehicles, because we have to essentially dump a lot of technology from the internal combustion engine and gas stations and so on, and invest hugely in new technologies, as we are in the battery factories, for example, but also in charging points. So I think this actually is damaging to productivity, not to growth. This, of course, is a source of economic growth, but I think it does hurt productivity. And another point is deglobalization. To the extent that companies source from other than China, they're probably going to end up spending more money to do that. China is becoming a more expensive place to do business, but it still has immensely competitive supply chain. It's quite difficult to source things for the same price in the developed countries, or even in Mexico or Eastern Europe or Southeast Asia. So I think that process is going to lower productivity, and that's going to hurt. So how these things will play out between the pros and the cons, I'm not sure. It may depend on just how effective the technology is, whether it can overcome the negatives from government policy. So let me turn to some of the risks. Risk number one I want to focus on is that inflation is persistent and that rates go higher. I think at the moment, the markets believe that the Fed has finished raising rates, that inflation will come down with or without a major slowdown. Some people think it won't be much of a slowdown, but inflation will come down. Others think there'll be more of a slowdown, and so that'll help inflation to come down. But what if that isn't the way it works out? What if inflation is persistent? Perhaps because growth stays stronger than anybody thinks. Then there's still a risk that rates go higher. And I think that that's a possibility that the markets might have to face over the next 6 months. It, of course, means you've then got a higher risk of recession later on because you've had another bump to rates, another shock to the markets. Could also potentially mean financial instability. If we see bond yields go up to 5.5, this is potentially going to unnerve the market. So I think this is a risk. It's one that's not really being discussed much at the moment. The markets are fairly confident the Fed has peaked, but it's something that concerns me. It's perhaps even slightly more likely in the UK or the Eurozone, because there's this question as to how well inflation is going to come down in Europe. The second risk, which is linked to the first, but not necessarily, is financial stability or financial instability. First of all, we've got the effects of higher rates. So we know that banks have these losses on long maturity paper, but we kind of had a clear out of US banks back in March on that front. We've also got pension funds, insurance companies, so they face this issue. Again, if yields go higher, still becomes more of an issue, but nevertheless, there's always the worry that things could still come out of the woodwork here. Then there's the refinancing challenges, particularly for commercial real estate, but also there's quite a lot of low-rated or junk-rated companies, which will have to refinance in coming years and may face problems. Linked to that, there's the questions over private equity. Of course, that's a fairly opaque field, but there is obviously quite a lot of distress in that field. It doesn't really become an issue for financial stability unless it turns out that banks have overlent to particular private equity vehicles. And we've seen a few rumblings around that in some areas, but that's certainly something to watch. If private equity becomes a generalized problem, what is the bank's exposure to them? And then private debt, which is a relatively, fairly new field, and it's certainly grown very, very rapidly. This is basically shadow banking. This is non-banks lending money to companies. It kind of faces its first potential credit cycle, particularly if we get a worse slowdown than I expect. There's the issue of leverage in hedge funds, which central banks always worry about. which apparently is relatively high at the moment. And then you could argue that valuations are relatively high in US large stocks, not as high as they were, but relatively high, particularly in relation to interest rates, and also in housing. So whenever you see high valuations, obviously there's a risk that in a recession, certainly, they go down and that creates more problems. So that's my risk number two, and it's certainly one to watch. And finally, geopolitics and elections. Excuse me. So, I mean, the Ukraine war obviously hit Europe badly, and it's been a major factor in the performance of the UK and Europe in the last couple of years. Hasn't really affected the US all that much in terms of the economy. The war now seems to be quite bogged down, but there are risks here. I mean, supposing Russia was to make a breakthrough against Ukraine, for example, that would be perceived as a risk. Or supposing Russia escalates in some way, perhaps driving up energy prices again. So there's issues over that. The Middle East crisis with the war in Israel and Gaza Strip, well, oil price remarkably stable or even quite weak, arguably, but I think there are still some risks there, so it's one to watch. And then we've got some elections. We've got Taiwan, which is certainly going to be a focus in January. Depending on how that goes, China may be upset, could lead to things happening on that front. So that's certainly one to watch. People will be nervous about that. And of course, we have the US next year and the UK probably late next year as well. There are a number of other elections not mentioned here. South Africa, I think, India, quite a few. But again, potential risks there to watch. So with that, I'm going to hand over to Gerry.
Thank you, John. And here also, thank you for changing a slide. I'll be talking about three opportunities. These are ones that we've discussed with John and James, and we kind of center on these this time around because we've already talked about things like Japan and stuff in previous years. And the things that we think may be quote unquote opportunities for 2024 would be the one, bonds are back. Two, the risk appetite for mid and small cap stocks, we expect that to resume, especially, given what John's been saying about the economy not having a hard landing in the US and potentially avoiding that in the UK as well. And lastly, we're going to mention tech shares because, like most people, we were surprised by the amount of gains we've seen in some select names this year. We were leaning towards, neutral allocations anyway to US large caps. So that's been good. But on the other hand, are these actually going to be the bets that people think they are? And we think the best way to approach them is to think of them as moats. That's going back to the old Buffett analysis. Some shares are basically being traded on the view that they have something of a special sauce that nobody else can either claim or nobody else can imitate in the near term. And so therefore investors are seeing these shares as something that you have to own rather than something that you can try to catch up with other ideas. Next slide, please, John. So the key thing about bonds are back is one, bonds hammered investors in 2021, 2022, and parts of this year as well. John alluded to the banking crisis in the US back in March of this year. And because we're involved in the markets, we already think that's ancient history. But a lot of people are probably still thinking, which bus ran me over? Because that was a horrendous banking crisis in the States, which they averted by putting a lot of sticky tape over everything and saying nothing to see here, move on. And the market has, remarkably. So what are we looking at now? Well, if John's right about inflation expectations and the actual inflation readings coming down, then we think the bond market is probably right in trying to bet on lower yields. So what have we seen here? The left-hand chart is global 2-year yields, and the right-hand chart is the global 10-year yields. And we're looking at basically they all rose in tandem, and now we don't expect them all to fall hard, but we do expect them to consolidate. In other words, you may see 5% again in Italian and US yields, but we don't think you're going to see 6%. We think you probably see something below 4% first before you see a sustained break of, let's say, 5.3 or 5.5. That's a huge call to make, given that we were hammering away at the upside, like John pointed out just a few weeks ago. However, on most of the charts that I look at, it looks like bond yields have hit good resistance levels and are probably more likely to consolidate towards lower levels and potentially peak out over the next year than they are to head higher or a lot higher. One of the things that we look at, obviously, is in the relationship between the 2 years and the 10 years. And we think the 2 year yields, the surprise of 2024, may be that they don't come off the highs as fast as traders would like. In other words, I think the market is betting heavily on a series of rate cuts next year, both in the US and other central banks. But one of the things that we think may happen is that you'll see central banks hold as higher for longer to try to basically ensure that, as John pointed out, the lower inflation targets are actually met or approached, or we're making good progress towards there. So in other words, yes, we think bonds are back. No, we don't think we're going to see a crash in yields, but we see yields fluctuating probably below the recent peaks in the major markets. And we would think that anybody with a long-term investment plan is probably going to be looking at these pullbacks with an eye to basically retapping the bond market and try to get some of those assets on board at a higher yield. Next slide, please, John. Now, this chart is familiar to all our clients, and it basically shows you what we put out every month, which is how are we doing? And in this case, I've highlighted the NASDAQ 100 as a proxy for tech shares, specifically US tech names. And if you've been out of tech over the last 10 years, you've missed out on a lot of returns. Now, we know that avoiding losses is one of the key things for investors and wealth managers, but making money is the other side of the coin. So it's one of those things where even though we are worried about valuations and we have these monthly meetings and inter-monthly meetings with John and James and myself, and we always talk about, what looks overdone, what looks like it's too cheap, things like that. The one thing we can't argue too much against is the fact that US tech has basically led the way for some time now. And obviously this year, it caught the eye once again. Now, it's one of those things where, yes, okay, momentum, you want to be long of US tech, then why the heck are we talking about the mid and small caps? Well, it's one of those things that we can try to keep an eye on most things. And we've been talking all year with ourselves and with clients about the fact that, we think the valuations in the small caps, UK and US, are a lot more attractive than they have been in some time. Now, the year-to-date returns in the FTSE 250 is dismal, negative 2% effectively on a price basis. And the 10-year return of 21% or 21.5 is really not that great unless you compare it to the FTSE 100. Now, remember, these are both price, so they don't account for dividends. But the FTSE 100 is only 12%. So it's one of those things where, yes, FTSE 250 is not great, but at least it's doing better over the long term than the FTSE 100, which is kind of sort of what you'd expect because you get more volatility and you get the smaller company returns and all that sort of interplay going into it. But still, at negative 2% this year, it hasn't set the world on fire. So it's one of those things we think for the story for next year is that, one, if the UK can avoid a hard landing or hard recession, then you may see money more rotated to the small cap ideas in this market. And for the US, Russell 2000, again, it hasn't set the world on fire at 2.6 return year to date so far. But if John is right about the US economy having a soft landing or avoiding a hard recession next year, rates may stay higher for longer, but they probably will come down at some stage in the second half of 2024. Then that should, in general, be a good thing for small and mid-cap shares as well. So those are the two ideas that we think are worth watching for next year. Next slide, please, John. Looking slightly more closer at it, and you can see on the left-hand slide is the Russell 2000. On the right-hand slide is the FTSE 250. Now, on both of these, you can clearly see that we haven't had a great couple of years, and we're well off the highs, whereas the S&P 500 and other measures of the broader markets are closer to the all-time highs. These are well off them. And if you do something like adjust these by inflation, as John and I have been talking about earlier before this talk, then they're very much off the highs. So one of the things that we're looking for is a bounce back. We're not betting the farm on new highs next year, but we are saying there's a good chance we'll see a pretty big recovery of the losses that we've seen over the last couple of years in these indices. Next chart, please, John. Now, let's go on to the winner. And again, we're using the NASDAQ 100 from the States as a proxy for US tech shares. And you can see that we're knocking not that far off the all-time highs, and we've had a really big recovery this year. There's not a heck of a lot more we can say about this other than tech does tend to get overvalued at times. It is a momentum swinger. However, at the moment, the momentum is swinging higher. Next slide, please, John. And just to summarize, on the US side of the market, we're looking on the left-hand table, the US S&P 500 sectors. And you can see on a year-to-date basis, technology is up 48%, communications are up over 47%. On a 10-year basis, the tech index has done very well at over 400% returns. So it's one of those things where we're underlining the obvious. People like tech investments. As John says, we may not know exactly how it's going to change the world, but we know that the world has changed over the last 3 or 4 decades, and it's mostly been tech driving the way forward, mostly US tech in terms of market sentiment. On the right-hand side, I have the S&P 500 communications chart as well as the S&P 500 technology chart. These are both weeklies. And you can see that the communications, the reason we have this here is the Google's in there or Alphabet. And it's one of the things that we think is going to power the sector higher over the next 12 months. On the tech side, it's got every single name you've ever heard of, including NVIDIA, and it's making new highs. So it's very, very difficult to argue against new highs in terms of we think this market is going to collapse with this out of the other. We don't necessarily think that. We think valuations are something we'll keep an eye on. But in general, if this is the future, then investors seem happy to place their money in trying to support it. So we would say what worked in this year may work again next year in terms of communications and technology, tech sector sectors in the S&P 500. Next slide, please, John. Now, that's it for our presentation in terms of risks and opportunities for 2024. James couldn't join us this time around, but he'd be happy to take your questions if you want to email them to us at some stage. And I know that we had some questions that we had to address as well. John, are you ready to take questions or?
Sure.
Okay. One thing we didn't talk about for 2024 so far is China. John, the question I have for you is we're kind of looking for China to basically bottom out and the economy to do better next year and to not be a drag on anybody's growth. What if we're wrong and the Chinese economy remains soft or even gets softer? What would that do to the global economy, in your view?
Yeah, that's a very good question. I mean, as you said, my view, along with many other people, is that China will sort of stagger along, grow 4 or 5%, gradually work through some of its problems, avoid a financial crisis, because ultimately the government underpins everything. But what if it doesn't work out that way? What if there is a panic? What if suddenly Chinese growth looks much weaker? Political instability, anything could go wrong. I mean, the possibility that we're talking about the China crisis at some point next year or in following years, I think is significant. Now, what would that mean? I don't think the Western financial system is particularly exposed to issues in China. In that sense, it's a little bit like the 1997 Asian crisis, or indeed the Japanese issues in the 1990s, where those issues were there and there are big problems in Japan and in the Asian smaller economies, but it didn't actually lead to a big issue for the Western financial system. However, I think if you had a panic in China and if we were all talking about a China crisis, that could be quite a shock because everybody knows how important China is for the world economy. It would presumably mean commodity prices falling, energy prices falling. That's good news, of course, up to a point. It would certainly be, a big discussion point in the markets. It would help, just as in 1997, the slowdown in Southeast Asia actually helped to bring inflation lower in the US, helped to keep the US economy moving. So it could work that way. But if it was a big enough shock, and China is more significant than Southeast Asia was, or Japan back in the 90s, then potentially it would unnerve people in the West and you'd see some kind of slowdown in growth. So I think it might depend on just how bad a China crisis was and how long it lasted. On the whole, though, as you said before, I'm probably the optimistic economist. I tend to think that we'd get through it without major ructions, but it will certainly give us something to write about next year.
Okay. So hopefully China avoids getting a softer economy. That way we can avoid.
It could be a little bit softer without being a big crisis. I think it's if we start talking about a crisis that's when you worry that there will be some kind of effect on the Western economies.
That's fair enough, John. And the other question that we haven't talked about in terms of stock markets and economies today would be Japan. Whereas last year we were saying, Japan was a big bet for us in terms of the upside, and that worked out pretty well. What do we think now?
Yeah, as you say, the Japanese stock market has done very well this year. I mean, if of course you've got a weak yen, so that offsets it to a degree. But I think the appeal of Japan is that the valuations on companies are still not particularly high, and many companies have lots of cash on the balance sheets, very strong balance sheets. We're seeing this gradual process of governance reform in Japan, which I think is important. It moves slowly, as everything does in Japan, but I think it's helping. And the Japanese economy, of course, is risky in the sense that it's caught in between the US and China. So there's always some political risk there. But if things went wrong with Taiwan or in some other respect, Japan is right in the front line there. So that's a bit of a concern. But the economy, everybody thinks Japan hasn't been doing that well, but actually it's been doing okay since about 2000. The economy doesn't grow very fast because the labor force is declining. But if you look at productivity, Japanese productivity is pretty good, actually. So they're doing okay. So I think that for me, it's still an interesting market. It's quite uncorrelated with Western markets. So I think it's an interesting market to look at.
Okay, but overall view is still positive for the Japanese stock market.
Yes.
Okay,
Yes.
fantastic. Thank you, John. And I guess, if you want to say any last words on, we talked about maybe hard landings in China and stuff. And I know you've addressed the US one. What are the chances of the US having a hard landing in terms of the economy? And here's the scenario. China slumps further, so Apple all of a sudden tumbles, and everybody else who gets a valuation from potential sales to China at some stage, Tesla, things like that. And the high mortgage rates finally bite, and we get the housing market bubble collapse. There we go. Not just the correction that we saw earlier this year, last year, but a real, humdinger of a typical real estate market collapse where, on a real terms and nominal terms, people say, why am I paying this mortgage when I'm upside down in terms of valuations, which we haven't seen since the global financial crisis back in 2007, 2008. What are the chances of that sort of thing, in your view?
Yeah, I mean, there's all kinds of things that can take you there, and you've named some of them, and obviously the political risks I mentioned, the geopolitical risks could take us down as well. And it's going to be tricky as we watch the US economy over the next 6-9 months because a soft landing, a slowdown, and a recession start the same way. They start with somewhat weaker data, and people getting a little bit more cautious. So you start on the same path, and then the difference is that with the recession, you suddenly go down hard. Usually inventories get involved, some kind of inventory correction, but also usually some kind of shock or panic, whether it's geopolitical, oil prices, those kinds of things. I still don't see it as being as bad, for example, as 2008, because I think balance sheets start from a much stronger position. I don't think house prices actually are as exposed now because we haven't had the huge building boom that we had in the early 2000s. So yeah, prices are high, but I think that's because of shortage of supply, not because of a speculative bubble as we saw back in 2006. And as I said, that means banks are not as weak, businesses are not so weak. So definitely a recession is possible. A really hard landing, I don't really see that. It doesn't, it could be an ordinary recession, but something bad like 2008, I don't really see that.
Okay, that's great news, John. Thank you, John, and thank you, everybody. We're going to stop recording now, and thank you for joining our webinar.